overhead costs. We've talked about overhead in the past couple of lecture videos in terms of how indirect materials and indirect labor go into the factory overhead account. So factory overhead includes all manufacturing costs except the direct materials and direct labor. Since actual overhead can't be cost effectively traced to individual jobs, there has to be an estimation of those overhead costs, because overall, those overhead costs are still important for cost accumulation to figure out what the total cost of producing a product actually is. So factory overhead costs come from a variety of sources. Indirect materials, and we get those cost numbers from materials requisitions. Indirect labor, those come from salary of supervisors or wages of employees, such as janitors. So not the direct labor wages for the employees actually working specifically on the job. This would be other employees who work on lots of different things. The factory power, that cost, to record that, you would find that on a utility bill. And then factory depreciation is also factored into factory overhead, and that calculation or that figure would come from the accounting department. There are 4 main steps in the overhead process in terms of accounting for the overhead costs. First, you set the predetermined overhead rate. Second, you apply estimated overhead because you've got to have that estimate. 3, then you record the actual overhead after it has already been incurred. And then 4, you reconcile those because obviously your estimate isn't going to be perfect. So you have your estimated overhead, then you input the actual overhead, and any difference you will close out to cost of goods sold. This image illustrates how the overhead process works. So overhead accounting requires managers to first estimate what total overhead costs will be for the upcoming period. Managers can't wait until the end of the period to allocate actual overhead to jobs because they need that cost information to be able to correctly set a price and monitor job profitability. Then at the end of each period, the company closes its overhead account, like I mentioned, closing it to cost of goods sold. But you can see that there are some calculations that go along with the overhead process. The first thing that happens is setting the predetermined overhead rate. So that is a very simple calculation where you take the total estimated overhead costs for the period and divide that by, for instance, direct labor hours. And you'll see some examples of that in terms of what an activity base is. But the important part to understand here is that first you calculate an overhead rate. You have to have some kind of rate. You apply that to the jobs using this calculation here, which is essentially just allocating those estimated costs to the different jobs. Remember, this happens beforehand because you still have to have these estimated costs. You have to have some sort of information to put in. Then at the end of the period, at the end of the process, you can see the actual overhead numbers that were incurred. Record those, and then any difference will be closed out to cost of goods sold. So to determine the predetermined overhead rate, I just showed you the calculation on the previous slide. And you can see here, it's the predetermined overhead rate calculation, which is estimated overhead costs divided by an estimated activity base. Once you have that overhead, that estimated predetermined overhead rate available, then you will multiply it by the activity base, which is a measure of production, for example, direct labor hours or machine hours. How you choose the activity base should be linked to the use of the overhead costs. The choice of which activity base to use affects the accuracy of job costs.